The checklist that changes everything. The difference between success and failure in life isn't about getting lucky or finding a secret path. It's about avoiding stupid mistakes. We've all heard stories about people making it big with the perfect timing, or finding some magical investment that takes them straight to the top. But the truth is, there is no secret to success. It's about one thing: avoiding the mistakes that sink most people. Imagine what could happen if you simply stopped making the same mistakes that have been repeating for hundreds of years. I didn't make my first million until I was 40, and my first billion until I was 75. The one thing I realized along the way is simple: stop doing stupid things. When I look back over 60 years of investing, I've seen the same mistakes being made by otherwise smart, capable people over and over again. The biggest tragedy is that most people don't realize their mistakes until they're 60 years old and broke, blaming everyone and everything but themselves. The thing is, it doesn't have to be that way. You can skip that decade of pain right now by learning from these 7 critical mistakes. Mistake number 1 is the most important. Don't learn from your own mistakes. Learn from others. Most people think they have to make every mistake themselves to get ahead. I learn from others because I don't have the luxury of time. I don't need to experience every failure to learn from it. I read obsessively, not self-help books or success stories, but failure stories. I read about stock market crashes, corporate frauds, and bankruptcies. Why? Because the same patterns keep repeating. From the South Sea bubble in 1920 to the dot-com bubble of the late 90s, the lessons are all there, if you take the time to learn. And you know what the common thread is. It's never different. You think you're special. You think you're going to sell at the top when the next bubble bursts. Guess what? You won't unless you study the mistakes of the people who didn't. And that's where the power lies. Learn from others and avoid those mistakes, and you'll be ahead of 90% of the market. So here's your first step. Read one major investing disaster case study every month. This one action will dramatically reduce your chances of losing money. The best part, it's faster and cheaper than making the mistake yourself. If you can learn to spot the warning signs in the stories of others, you'll be miles ahead of everyone else who is chasing the next hot tip. Now, let's move on to mistake number 2, the dangerous game of blind investments. Most people think they're investing, but they're really just gambling. Here's the painful truth. You're probably buying things you don't understand. It sounds obvious, right? But I see it all the time. People invest in things they don't even know how they work. For example, can you explain how Bitcoin works? Can you explain blockchain or mining or proof of stake? If you can't, then you were not investing. You were gambling. Here's the thing. I don't invest in things I don't understand, and I'll tell you why. If I can't explain how an investment makes money in one simple sentence, I don't buy it. People spend more time researching a toaster on Amazon than they do understanding the companies they're putting their money in. I passed on massive opportunities in the 90s because I didn't understand tech stocks. People laughed at me for not investing in Amazon when it was a small company losing money every quarter. Did I miss out? Sure, but I didn't lose anything. And here's the point. You can't win them all. What matters is avoiding big losses. And if you want to make it in the investing world, don't try to get fancy. Stick to investments you can explain to a 10-year-old. Keep it simple. I didn't touch mortgage-backed securities before 2008. I passed on Enron and WorldCom. Why? Because I understood they were garbage. You can't get ahead by making guesses on complex, speculative assets. Focus on businesses you understand. That's where true wealth is built. If you're unsure about an investment, follow this rule. Can you explain how it generates cash? Can you articulate why the business will succeed? If you can't, sell it and stop wasting your time. Now that you understand this, let's dive into the third mistake that's holding you back. The urgency that destroys wealth. Wealth isn't built by rushing. It's built by waiting patiently. The third mistake most people make is the most dangerous. You're in a hurry. You want to get rich fast. You want to be a millionaire by 30. But that's not how this works. I built my wealth over 60 years, not 6 months or 6 years. The fact that most people want to get rich quick is exactly why they fail. There are no shortcuts, no secret formulas, no magic stock picks that will make you an instant billionaire. In investing, patience is your greatest ally. The secret is not in buying and selling at the perfect moment. It's in doing nothing. The real wealth is built in the sitting, in the waiting. But here's the catch. Most people can't handle it. They look at others who made big returns in a short time, and they panic. They start trading, trying to catch the next big trend. Guess what happens? They end up right back where they started, worse off than before. You need to resist the temptation to chase every shiny new thing. Let me tell you something. If you can average 20% per year, that's all you need. Compounding is what makes you rich. Over 60 years, a 20% return on your investment turns $10 zeros, zero into $500 million. That's not hype. That's math, and it works. But here's the catch. Most people don't have the patience. They chase the quick wins, the hype, the next big stock. They take on huge risks trying to hit a home run, and most of the time they strike out. If you want to get rich slowly, focus on the long game. Avoid the drama. Don't engage in the market's noise. Stick to your strategy and be patient. It'll pay off in the end. And if you need proof, let's take a look at the next mistake that most investors are making. The myth of diversification. Diversification doesn't protect you. It dilutes your potential. Mistake number 4. You think diversification means owning everything. Wall Street loves to tell you, don't put all your eggs in one basket. They say diversify, spread your risk. But here's the truth. Diversification is protection against ignorance. It's a strategy for people who don't know what they're doing. If you really understand investing, you don't need 50 stocks in your portfolio. You need a handful of businesses you truly understand. I've had times when 90% of my net worth was tied up in one company, Berkshire Hathaway. Was I crazy? No. I understood that company inside and out. I knew how it made money. I knew the management. I knew the people running it. The result, that concentrated bet made me a billionaire. Over-diversification is like trying to build a portfolio based on gut feelings rather than knowledge. If you own 50 stocks, how can you possibly understand them all? You can't read 50 annual reports. You can't track 50 different industries. You're not investing. You're just building a do-it-yourself index fund. The smarter approach is simple. Find 6 to 10 great businesses that you truly believe in. Companies with long-term, sustainable competitive advantages. Companies you understand. Companies that generate cash and have competent management. These are the companies you hold for the long term. Forget about trying to own everything. Pick your spots wisely and you'll end up ahead of the pack. Now let's move on to the next mistake, one that costs you more than you think. The hidden cost of fees and taxes. The fees you pay are quietly draining your wealth. Mistake number 5. You're losing a fortune in fees and taxes. This one's boring, I know. Nobody likes to talk about expense ratios and tax efficiency. But let me tell you something, it's costing you more than you think. Imagine this, you invest $10 zeros, zero, and earn an average return of 10% for 30 years in a low-cost index fund with a 0.04% expense ratio. You end up with around $8 million. But if you're in an actively managed fund with a 1% annual fee, that 1% fee takes a huge chunk out of your returns. You end up with only $1. 5 million, that's $3. 100 zeros, zero gone, just like that. And most actively managed funds underperform the index. That's not a mistake, it's a guaranteed loss over time. The same goes for taxes. Every time you sell an asset, you pay taxes on your gains. If you're constantly trading, you're giving